Okay, well, let's welcome everybody quick here. So this is our monthly market update, mainly mortgage market update, but we do include Jake Brendel from Goosehead Insurance to talk about insurance topic issues. And I always have some topics, just real estate news, legal updates, anything that I feel might be important to mention that isn't big enough for a whole webinar. So we'll start with Adam Bruner from Flagship Home Loans, our partner mortgage company, and he'll talk to us about what's going on in the market. Of course, lots of big news and things are crazy every day, it seems. So he's going to catch us up on the last month's worth of news.
Yeah, where do we start, huh? So lots to talk about. I guess we'll get right down to it. If you watch my market in the minute updates that go out to everybody that was invited to this, um, the big thing is the bond market, right? Our interest rates come from the bond market, not from the Fed. Now, there's a trickle down effect, but more directly, the bond market provides the supply for the mortgage money. So when the bond market is doing well and the prices of bonds are going up, there's more supply, mortgage rates go down, and vice versa. So let's talk a little bit about where or what affects the bond market. In a normal economy, you have, and when I say normal, right, anything outside the past 2 weeks, you have the bond market and the stock market competing for the same pool of money, basically. And when the stock market is doing well, people are going to park their money in the stock market and not in bonds because there is more return. There is the greed outweighs the fear in those environments. Okay. Now, when the stock market does bad or there is fear in the market, people will move their money from the stock market, or not necessarily move the money from the stock market, but new investors or people that have money are going to be putting money into bonds, not into the stock market because bonds are safe. All right. And one of the most tried and true, safest financial instruments out there is the US bonds, our treasury bonds, mortgage-backed securities, and the whole world invests in our bond market, and it's very strong. So really, when we see a weakening of the bond market, it's usually because money's going into the stock market. But we saw something a little bit different over the past 2 weeks. And could we, how do I share my screen,
If
Danielle?
you move your cursor down at the bottom, there should be a little green button in the middle that says share.
There we go. It was right in front of me.
It's okay.
Okay. All right. Can everyone see my screen right now?
No.
No? Okay.
Oh, there you go.
All right. So what we're looking at right here, all these
Hold on.
little candlesticks. Can everybody see this?
Yep, there
Oh,
you
there it
go.
is.
Now it's
Okay.
working. Yep.
So all these little candlesticks are daily movements in the market over the past 6 months. Okay. Red goes up and is bad. Green is good and goes down. So we are talking about mortgage-backed security prices. That is the really the measuring stick where most of the bond market is tracked. So when we see green, that's very good. The price of bonds is going up, and typically that means interest rates for mortgages are going down. So just looking at the past 6 months, we kind of really notice two things. If we're most sensitive about the bottom, and remember, rockets and feathers, mortgage rates go up like rockets, down like feathers. Therefore, the inverse to that is the bond market goes down like rockets and goes up like feathers. It goes up slowly, goes down fast. So if we look back here, let's look at some of these areas where we see big movement, right? Well, the first thing, this resets every couple minutes. So if we go back, let's look back at what happened in, oh, I don't know. Let's look at, let's see here. This is March, December, November. Back here around the beginning of November, when Trump got elected, we saw the bond market go down a little bit, because initially the stock market went up, right? When Trump got elected. And then again, let's look what happened at the very beginning. Oh, around the time that Trump was inaugurated, right? We saw the stock market go up, we saw the bond market go down. And if we don't look at the far right of this graph and we just observe everything to the left, we see that the biggest red candlestick was right there, January 10th, right around inauguration when the stock market went up. And that's a huge move because you see in a normal setting, you have little movements every day, right? So that's what happened. Money moved into the stock market. Now, there's other things that have happened here. I don't quite remember what happened around February 13th. Probably, I think I know what it was. It was the announcement of the tariffs, right? That was just announced. And then when did the tariffs kick in, right? Boom. You don't even need to know. You can just look at this graph, and it was right there at the beginning of last week. And if you remember, some of those tariffs kicked in on the 7th, some of them kicked in on the 9th, some of them kicked in on the 11th. And with each one of these, we saw the bond market going down. Now, that's a little counterintuitive, right? Because the tariffs are adding costs, and that also caused our stock market to go down. Let me go back. Right here, same 6-month graph. Let's look back at the beginning of April. Boom, right here. It's a little less noticeable on this, but do you see how sharply I'm sorry, these are the interest rates. The interest rates shot up right here. This is not the stock market. This is our interest rates. So you can see how it correlates directly with interest rates going up and the stock market. Oh man, I lost my grabber bar. Hang on. And the stock market going down, bond rates, I'm sorry, the interest rates going up and the stock market going down at the same time that the bond was going down. So what's actually happening there? That's money actually leaving our economy. Those are investors globally, domestically that are taking money out of our economy, out of the stock market, out of the bond market and putting it somewhere else. Because normally the bond market and stock market are inverse. So for the first time in a very long time since I've been a loan officer, I think we would have to go back to maybe the Great Recession of 2008 when we had some issues there. So that's really the craziness that is driving our stock or our interest rates. But as big as these movements are, as scary as those red candlesticks are, look at what it actually did to our interest rates. We're talking about from here to here. We're talking about an average interest rate on an average 30-year fixed Fannie Mae Freddie Mac loan from 7.07 down to 6.98. It's really not that much of a movement in the interest rates. But what does the media do? The media whips everybody into a frenzy. And I'm not making this a political conversation, but I've had so many borrowers and so many people contact me about, especially people that are building new houses where they're breaking ground next month, but they're only closing in September. I mean, I have people going, Adam, what if interest rates go up to 8%? Can I lock in right now? I mean, they can lock in right now. There's a big cost to it, but do I recommend it? Probably not. Now, nobody has a crystal ball, right? But you see right here in the past 2 days, over the weekend, Friday was a rough day, right? But look what happened yesterday. Boom, we're back up and we're almost halfway in the bond market back up to where we started when the tariffs hit the beginning of last week. Okay. Now, the one thing, nobody has a crystal ball. All I can do and all we can say to our buyers is if you have a good interest rate in front of you that works for your family to buy that house, lock in your interest rate. That way you can sleep good at night. And if the interest rates go up, or I'm sorry, if the interest rates go down, maybe you can refinance, maybe you can switch lenders, maybe you can float it down. But if the interest rates go up, you're protected. Okay. That's all we can ever really say as mortgage professionals is explain what's going to happen. You will never hear me predict, hey, rates are definitely going down, rates are definitely going up. We might talk about things where that could happen. And we knew there was a good chance going into this week that the bond market would rebound. And of course, a lot of this is based off of whether or not they're going to pull back those tariffs. But all those tariffs, they're still there, but they just put a little hold on them for a little bit, or they pulled them out of certain segments of the economy. So hard to say where it's really headed. But again, I want to make sure that we're not panicking too much because look at what it really means to the average interest rate right here. Okay. Now this is closed loans, so a lot of this is going to continue to go up a little bit as far as interest rates. Um, but I don't think it's as bad as people are seeing it. And actually, if we go back to the Friday before the tariffs kicked in, interest rates were at 6.6 and went up to as high as 7.07. So you're talking about less than a 0.5% move there on average. Okay. So what that really means to people is maybe paying a little bit more in discount points to keeping the same rate, or possibly for most of my buyers, they are staying within 0.25% of where I quoted them over the past 3, 4 months. So again, nobody has a crystal ball, but I just wanted to put things in perspective because if we zoom out over the past year, look how it really puts things into perspective. Look where rates were a year ago. Rates a year ago were 7.5. They got as low, and again, these are average rates, so take it with a grain of salt. They got as low as the low sixes, but we're not talking about life-changing swings here for a whole lot of buyers. So I always try to put it into context. What are you guys seeing? Any concerns from your buyers, Zach or Layla?
Everyone asks me about, they all ask me about rates all the time, right? I just tell them like they've been improving,
Hmm.
over the past 2 weeks, and then I just send them to you for updates,
Hmm.
further than that.
Yep.
I'm
Layla,
very much a new agent, so I don't have a lot of things going on right now.
okay, okay.
Mhm.
Well, this is a good time to kind of learn and see what's happening with other agents and happening in the market. This is a really good time to sort of just kind of pay attention to rates and see that a lot of times what's whipped up in the news is not really in line with what's hitting the streets, and that could be a good thing or a bad thing. But all things considered here, we're not talking about huge swings. Very few buyers are really going to be affected by these changes. It's a little disappointing, but we're not seeing people really having to change the price point that they're looking, or worse yet, not qualify for the loan that they did, 2 weeks ago or 3 weeks ago. Danielle, what are your thoughts? I mean, Danielle is as much of a mortgage. I know we paint me as the mortgage expert in these things, but Danielle's pretty damn good herself. So I always like to hear what Danielle has to say.
No, I tried to not make, I had lists of updates and I tried to not make them any mortgage related. I didn't want to step on your toes. So I didn't write down any mortgage updates.
Okay.
I'm actually preparing a broker level 45-hour finance class. So I had plenty of mortgage things, but I was like, I'm not going to talk about mortgages today. So,
Yeah. So I mean it's tolerable, and as long as we stay in this channel, I think we're okay. Where we run into some trouble is the bond market, and the reporting is always 30-day lag, right? So normally the bond market is reacting to reports about inflation. The bond market's reacting to reports about job claims, and a big part of that is a 30-day lag because the government reporting is garbage. The reporting that comes from our federal government, I shouldn't say it's garbage, but the market doesn't react to it because it's really hard to report on things like inflation and things like unemployment. Do you know how the government reports, or anybody reports on inflation? They have secret shoppers that go to grocery stores, and they have people that literally put butter in their hand baskets, and they mark down how many ounces the butter is and what the cost per ounce is, and that's how they, as far as consumer products, it gets down to that level, right? So it's not like there's some sort of big computer and big computer screen where day to day you can see what the jobless claims are, or where inflation's going. So a lot of this is in arrears, and a lot of it gets edited in the months to follow. All right. And that's where sometimes, with fear and greed, we think it's going to be here. And then it turns out it's really here. It's still bad. But because the market was expecting it here and it was here, we actually had an improvement when we were thinking that it was going to be worse. So that's why I don't play the float game. That's why I don't sit here and try to predict what rates are doing. But the scary thing is, and what I'm a little concerned about is the tariffs are hitting right now. And the reports about inflation and job losses are going to be 30 and 60 days in the future in relation to these tariffs. So we are in a position where if the market is already prepared for that and the news isn't as bad, we might see rates get better. If the inflation numbers and jobless reports are worse, we might see a continued slide in the bond market.
Yeah, I
So
think,
I say all
yeah.
this to say we really don't know.
Yeah, I think some of the research I was doing too is because I'm not terribly old. I feel old some days, and but the average recession, if that's what we end up in technically, lasts 10 months. And I was like, oh, like that's not very long, if that even ends up being what we end up in. And so I think people might be preparing for something way worse than actually happens. And we actually end up coming out of a recession faster, and people do still feel it for a little longer. Like Adam's saying, the news kind of, sometimes things lag on. But as a webinar here that is across multiple markets, every market's going to feel it differently in a different way. And so, encouraging your consumers that even though they're watching the national news with national statistics, it's really important to listen to their local professionals, because we know what's going on in the local market. We know what's happening with home prices, home values, buyer and seller motivations. And the vast majority of our economic system is built on faith. And so we can almost self prophesize or self fulfill a recession just out of fear. And so, yeah, it's okay to stock up on some toilet paper and maybe not go out to the movies every weekend, just to be a little bit prudent with our money. But if we freeze spending, we're going to create the thing we fear. And so, really, as being professionals in the economic industry that we are, being in real estate, it's really up to us to help with our friends, our family, our clients, to explain to them that one, we're a hyper local market. And in some of your markets, you might have industry that is recession proof. You may have warehouses, factories, things that, rail yards, whatever that is. And you might be able to say to people, yeah, the news sounds bad, but we're so strong locally. Our local economy is so strong. We're actually recession proof. Did you know that the warehousings and things that we have, the trucking industry, we're going to go just like we saw in COVID? We did fine. We're going to do fine through this too. So don't panic. And actually, panic is going to make this actually happen. What you fear most will happen if you act out of fear. And so we can be the voice of reason and calm, explain to them house values are great, interest rates are great. Just putting out that messaging, even if it's on social media, your TikTok, your Instagrams, we can help keep the calm and ride this out maybe a little more level than it could be, and avoid some of those peaks and valleys and spikes that we may see otherwise. So I think it's a blessing that we're in the positions that we're in to put out those calm messages.
So true, so well said, Danielle. Absolutely.
Yeah.
Yep. And one more thing to add. I don't ever want to get political. You will never see me publicly speak about preferences politically or anything like that. But I do want to share a little bit about what the bond traders and what the information that I watch and monitor is saying about why Trump is doing this. Okay, Trump very much wants the Fed to lower interest rates. The Fed doesn't want to lower interest rates until they're sure that inflation has been curbed, and then they can lower the interest rates and let the market fly, right? So what Trump is almost doing, and I'm not sure if people are really suggesting this, but this is brought up on a couple different sources, is that he wants to create that stability to drive down the bond to force the hand of the Fed to lower interest rates sooner than later. And to me, that's the one thing that I've heard so far that was like, you know what? I kind of see that. I can see why that might happen and where that might be true. No one knows for sure what's really going on and why they're doing that, and being so wildly all over the place. But that could be one reason behind the scenes as to why that's happening.
Okay.
Um, One more thing that I wanted to touch on, Danielle, you had mentioned about Fannie Mae and Freddie Mac, possibly, I think you said the Home Ready program possibly going away. I didn't hear any industry news about that, but I think what you might be talking about are the special credits that lenders were getting,
Okay. Yeah, it was something I knew
potentially.
about special first-time home buyer programs or something, and I
Yes.
okay.
Yeah. So
Yeah, those
if
things.
if if we just kind of back up, Fannie Mae and Freddie Mac used to be quasi or privatized companies, right?
Yes.
And then over the past 15, 20 years, there was just too much. They were too big. They
Yeah.
were too big. The government had to step in for a number of reasons, lay down some rules, provide some stability there. And right now, they're considered government-sponsored entities. They were quasi-government agencies or quasi-government entities. Now they're government-sponsored entities. But for the most part, the federal government is dictating our most of our guidelines, 99% of our guidelines, and Fannie and Freddie are pretty much the same across the board. Um, it seems like the current administration is trying to push that back to the private sector. And that's okay. Not a big deal either way. As long as there's some oversight and regulation, I'm not necessarily against that. Competition is good, but what they are terminating are the special purpose credit programs. And those are, for the most part, for lower income and for first-time home buyers. But to be specific, Danielle, these are not Fannie Home Ready and Freddie Home Possible programs. Okay. These are additional credits that Fannie and Freddie give lenders to create their own programs. And this is the article that I most recently found that came out um, at the end of March. And I see this happening with our lenders. We are signed up with United Wholesale, and some of these other banks. But I wanted to kind of remind people of something. What do you think these banks do with those credits? Yes, they create programs. Yes, they give first-time home buyers money towards certain things. But when that comes from the government, they don't just pass that on to the consumer. A lot of that money is used to just kind of move that needle a little bit to where they have advantage over their other competitors. And a lot of that is going into the pockets of the banks. So I don't think at the end of the day, Danielle, that our buyers are going to be having a big effect by that. In fact, all of these programs that are on this sheet, I haven't used any of these programs with any of these lenders in the past year.
That was gonna be my question. Like, how impactful is that gonna
Yeah. Now, that's not to say that it doesn't create less competition in that bucket. And raising tides raises all ships. So there could be trickle down. Anytime this happens, there is a chance that there is some impact around the industry. But the programs that we've relied on, the programs that we have, they still remain. But it is affecting these lenders right here. But I really think the impact is more directly onto these lenders and not so much our home buyers.
Okay. Thank you.
Yep. Now, that being said, Danielle, did you hear anything or read anything else in addition to that?
No, no,
Okay.
just that.
Gotcha. Because yeah, if Home Ready or if Home Ready and Home Possible were going away, that would be we would be having meetings with lenders. We would be having powwows left and right because that's probably a quarter to 30% of the business that we do are those affordable programs like Home Ready, Home Possible, and they're not changing.
Okay. Good. Excellent.
All right. Thank you for your
Okay.
time there, guys. Sorry if I went a little bit long. That was just
No,
a
it's
lot
fine.
to.
Yep. Just make sure to stop sharing your screen.
Yep.
All right. Awesome. Well, Jake, anything for us today from the insurance world?
Lots of super exciting stuff in the mortgage world. Yay. I think the theme for this call might be keep calm and buy on, right? With, with all the uncertainty in the market, the insurance world probably not helping a whole lot of things right now. With the way that the market has been. If you've been on one of my calls before, I've probably ranted and raved about that a little bit. Guidelines are still super strict, especially roofs. That's always the big one. A lot of them still at 15 years or newer, some going up to 25 years old. I think with the theme of, hey, let's calm and get buyers through the process. I wanted to just kind of, I guess, get the point across that I get calls every single day from buyers that are already in a tizzy when they get to me, specifically about insurance. Hey, I can't find insurance. I'm having trouble. They won't insure this. They won't insure that. Or a big one is with the uncertainty in rates in the market. Hey, I need to hit a certain number in order to even qualify for the loan to be eligible for those. And I guess my point is, with all of the uncertainty in the insurance market and the mortgage industry, I think it's more important now than ever to get your buyers to a local professional, whether that's for mortgages. And I think the same could be said for the insurance industry as well. Find somebody that has multiple options to be able to shop the market, find a solution that's best for your client while controlling rates as much as possible, right? I think if there is a little bit of good news to be had right now, and there certainly is, these cycles, I like to call them, in the insurance market are exactly that. They are cyclical. So these are for-profit, publicly traded companies. So eventually they have to get back to growth mode, right? Their investors require that. So we're starting to see some of that where they basically have turned off the lever, so to speak, for a couple months, slowing down new business, ramping up those guidelines to essentially create barriers for buyers. Hey, we don't want to insure houses right now. Starting to see some of those levers come on a little bit, right? Where there are some of these companies that haven't wanted new business, specifically on the home side, are turning that on a little bit and are becoming more and more receptive to new business, which is good for the overall market. More options typically means better pricing. Now, to use Adam's feather methodology, that will come slowly, because just because they're opening the lever, so to speak, there's still going to be those guidelines, and I think we'll still have those guidelines for a while, right? Because profitability is still super tough for these companies to come by on the home side. With inflation still being uncertain, I think that has a big play in it. But also with everything that you see on the news as far as wildfires, hurricanes, really on what seems like a weekly or bi-weekly basis at this point. Anytime those things happen, they are huge to the bottom line of our insurance company. Struggled to be profitable, those certainly don't help, right? So stay with me there on the roofs and those certain guidelines that make things, I think, difficult for our buyers. But there are still plenty of companies that will offer affordable solutions for our clients. You just got to get them to the right scenario from the beginning, I think, before, some of those emotions get in play or whatever you want to call it. Because I think we're all on board here. We want happy clients. We want smooth process to get them through there without any hiccups really whatsoever. I think that creates a great business environment for all of us. So I think that's the big one I wanted to get across. A couple small quick hitters that not everybody thinks of when it comes to the insurance market that you should just have in the back of your head, especially as we try to get them, with DTI, especially those with DTI issues, right, through the process there. Dogs is one that is super fun right now because the options are kind of funneled. There's not a huge amount of options to begin with. When you start hitting some of these other things, it really funnels them. So if you have a client with the typical Rottweiler, Pit Bull, or some type of quote unquote vicious dog breed, for the record, I think they're all sweethearts, depending on that. But the insurance companies definitely do not not think so. It's just based on historical statistics, really. So I think that should be, kind of a trigger, even more so with everything else going on. Hey, get them to somebody that has some options. If you know of a client that has had claims on the home side, another huge one, where a lot of insurance companies won't even consider it right now if they've had one claim within the past 5 years in order to be able to insure. If you got two or more, it's going to be really tough go, right? One, there's probably some leeway there, and that typically will file your buyer, not necessarily the house in every situation. So if your buyer had a water claim on a prior house and they're selling that house, buying a new one, that will certainly impact the home insurance policy on the new house, right? So that's a big one. Other one is distance to fire. So we call it protection class in the insurance world. So our buyers that like to live in the boonies, so to speak, they are farther away from quote unquote fire departments. Or the other thing that plays into it, that fire department could not be rated as well as some of your larger fire companies, meaning it just takes them longer to get to said fire, right, due to distance or just employees, right, people to kind of help those types of things. So that will hurt pricing ever so slightly, right? These aren't huge factors by any stretch of the imagination, but with some of the uncertainty on the rate side, every dollar helps, right? Some of these people to get through and actually buy the house. And then I'll end with some two things that might help because we like to end on positives, right? So discounts, home burglary, fire discounts, those are certainly available. I wouldn't say that they're life-changing discounts by any stretch of the imagination. The better the system, the better the discount, so to speak. So meaning your like Ring cameras, yeah, not really necessarily considered an alarm system, so to speak. I think there might be one carrier that I've ever seen that will give a small 5% discount for them. But we're looking for things that will either sound some sort of alarm to bring attention, or even better, the alarm systems that will report directly to police and fire. Those are the ones that have big dollars as far as premium is concerned. If you guys have a system for those alarm systems, certainly use that. Have your clients tell them to get your insurance folks involved in that. They need a certificate for those things in order for a discount to apply. Insurance company wants to see proof. And then we also have some solutions too, that if you have clients that are interested in security systems, we have companies that will come out and set them up for them and shop for affordable solutions for them. And then last but not least is auto discounts. I think that's the one you've probably seen that on every insurance company's commercial by now. But they are huge. So I think every buyer that I come through that talks about home insurance, I'm going to talk about auto insurance because the discount can be pretty significant by the nature of the amount of companies that I have to shop. Um, Usually works out pretty good to save them money on auto insurance as well. It's just, again, a matter of more options, meaning better pricing. So we not only realize the discount on the home side, save the money on the auto side, and get everything bundled in one neat shot, is a win-win for really everybody involved. So just some quick hitters, some quick things to touch on today for our insurance market. As always, Danielle usually bombards me with some kind of a weird question that has happened in the last month or so. So what do you got?
You knew it was coming. So I do have a question. Um,
This
um,
is my favorite part of the
Yeah,
Zoom calls, but
me too. It puts me on the
Oh,
spot every
I
month.
know, right? Yeah, it's quiz Jake time. So what about when you have a roof that's like, say it's 15 years old? There's that product out there now called Roof Max where they can extend the life of the roof for like 5 years. Like, would that qualify to make it like a 10-year roof, or insurance companies are like, nah, no thanks?
I would love to tell you that that was a thing, and they would be like all about these special shingles that make them 50-year lifespans or whatever. There's so many things out there. Your roofer has all these different solutions, but insurance company does not care.
Okay.
Really, it's about when the year the roof was replaced, is the bottom line. Some of them will allow you to like fix it slightly, but like, I mean, you're really pulling straws for that type of stuff to happen. Yeah. I
Okay.
actually, fun fact, I insured a 1932 original slate roof last week. So there's still some options out there for
Nice.
some crazy scenarios.
That's cool. Also, I thought I'd bring it up. So I had just recently, for my Pennsylvania people, I think most of us are Pennsylvania, if not all. I recently discovered PHFA has a really neat product. It's for replacing septic and sewer lines that break. They have like a 1% loan for 15 years for homeowners. And a lot of people probably don't know that. And I was talking with my dad about it in the car. I was like, oh, that's what I found. But it also brought up that I had found out because I had had several friends in the last year or so who had to replace their sewer lines. And I was like, I don't want that to happen to me. So I had called my insurance agent, who's sadly not Jake, but I recommend Jake to everybody. But I've had the same person since I was like 16. And so I'm a loyal bunny. But I said, hey, like, do I need to be getting extra protection for my sewer lines? Blah, blah, blah. And he was like, no, like it changed whatever time period ago that the sewer lines are protected on your policy because you can't see them to maintain them. So is that something that all insurance companies do now or just certain ones? Like, can you speak to sewer line protection that we can let like our clients know what they should be doing so they don't pay for the extra stuff that comes in the mail, or like talk to us
Yeah,
about
for
sewer
sure.
lines? That's such a huge
Yeah,
issue right now.
well, yeah, because houses are getting older, right? And
Yeah.
these lines are buried underground. So eventually they're going to have an issue, right? Leak, tear, rupture, crack. And especially some of these ones that are cast iron originally, those are the ones that are
We
really,
get a lot
really
of post
starting to fail.
closing issues on this. Like I've
Yeah.
had a lot of agents call with like post closing issues between buyer and seller. And my first thing is like call your insurance agent. So anyway, keep going.
Yeah. Yeah. Because cast iron, it just deteriorates from the dirt, really, but you also have tree roots that will grow through those lines. So on the home side, yeah, I mean, pretty much every company at this point, I can't think of one that doesn't offer that type of endorsement. But the kicker is like it's an endorsement. So you have to have a, either a good quality agent or an educated buyer that knows about that to be able to inform because you have to manually go in and add it. It's not included on the base policy. For most insurance companies, they're going to give you up to $10,000 maximum for that endorsement worth of coverage. And that's also true for your water lines as well. So water, sewer, gas lines that typically run underground are all included on that. They call it usually a buried service line coverage or utility line coverage or something of the sort. And usually it's cheap. I mean, I would say ranges somewhere between 30 and maybe $65 a year. So for what it covers and the how often it happens, in my opinion, it's a no-brainer. That's something that I will talk to every single client that comes through the door on that one because it's probably one of my most common claims that happens right now.
Okay. Good. I just wanted to make sure. So as agents, we can be also like just helping our clients, advocate for that if it's an old house or there's not a lot of knowledge on it. And again, I'm seeing a lot of post-close issues too between buyers and sellers, agents coming to me with that issue. And it's like when they go, they go. Sorry, it was a week after
Yeah.
closing, but no one knows they're going to go till they go. And I had never realized they were covered by insurance because I asked my agent like 3 times, like, are you sure? Sure. I feel like it shouldn't be because you get these things in the mail and you think you need to have extra protection. And my dad's paying
Yeah.
for it. I was like, stop that. because
Yeah.
we have the same insurance. We're always like,
Yeah,
oh,
water
we're
companies
over
are
insured.
notorious for that. You probably get one once a month where they want to sell you some kind of protection for that. But yeah,
Yeah.
and I
So,
don't know, to be honest with you. I mean, just being in insurance, I never looked into the water stuff before because I know I had coverage elsewhere. I don't know what the coverage is up to for the water company, but I would imagine the insurance. I mean, $10,000 to $15,000 is a pretty good chunk. It's probably the average cost though, depending on scope of work. So heads up, they can be expensive, but it's happened to me, and it was like, I don't know, $7,500 for a 1 foot section of pipe, in my backyard. So it just depends on scope of work, really. But yeah, and
yeah.
for the cost, I mean, it's almost always going to be cheaper to go through insurance than paying, what the water company would charge you
Oh,
or
for
whatever.
sure. For sure.
Yeah.
So awesome. Well, thank you for that.
Yep.
So for my stuff, not a ton of stuff. One was just to mention, I'm sure you've all seen a ton on the NAR Clear Cooperation, tons and tons of emails and news articles about NAR and their policy on that clear cooperation and their new exempt status. Um, if you're in the Bright footprint, nothing has changed. All of our statuses are the same. If you're not in the Bright footprint, check with your MLS. But basically, what NAR is saying is that we all are still going to cooperate and share our listings with our other MLS participants. So if you take a listing, you need to share it in the MLS with Layla's dog. Oh my God. Um, you need to share your listings within 1 business day of marketing it to the public. So once you begin marketing efforts of any kind within 1 business day, you do need to share that with other MLS participants of which you are a part of. But there is now that extra option, which again, we've always had in Bright, or not always, but office exclusives is what the Bright MLS calls it. Whatever multi-list you belong to might call it something else, where if the seller does not want it to go out to MLS participants, they just want you to share that internally with your office. For privacy reasons, that is an option. So sellers have as many options as possible to tailor their sales experience the way they want to tailor it. They can do that. Just knowing that if you do begin to market it outside, you do need to share that then in the multi-list. But for Bright MLS, there are some exclusions on that the seller can direct you to market it on Facebook or things like that and still keep it out of the MLS. So there is an office exclusive policy that covers all of those small nuances. So check with your MLS, see what options you have in there, but basically nothing really fundamentally changes. We are just still cooperating with our cooperating brokers. Couple little tiny things. One, because today is tax day, I wanted to share a tax tip with everybody, and this goes for everyone on the call, even our gentlemen. That check with your accountant on the specifics, but as a self-employed person who runs your own little business, you can actually pay your children. So you can pay your children up to $15,000 per year for 2025, and that's a tax deduction to you as the business owner, and your children don't pay taxes on it, not self-employed taxes, and check on the taxation depending on their age and such, but they'll basically be tax-free as well, and it's just a nice little way to pay your children. They can put away for college, and you get a tax deduction on your taxes. But again, check with your personal tax preparer on how to structure that and what implications that would be, but that's always a fun little tax write-off to pay your children for. They actually have to do work, like put like labels on things or stuff envelopes or, you know, little tiny clerical work. Okay. They get older, they can do Canva and social media graphics for you and things like that. Next is warranty waivers. So getting the warranty waiver signed is so important. We had a member of our association up here who got sued, and him and the other agent in the deal got sued for $250,000. Their E&O kicked in, but they would have had to pay the $1,000 deductible had they not had a warranty waiver signed. So even though there's a warranty explanation in the agreement of sale, the fact that they had a warranty waiver signed saved them the $1,000 deductible. So the E&O company did not make them pay the $1,000 deductible because they had a warranty waiver. So just make sure you're always getting that signed on your deals. If the folks do not get a warranty, get that waiver signed. It does protect us. Two more pieces of news. There was going to be new legislation starting this year that limited banks charging overdraft fees for customers, but that got rolled back. So they're still allowed to charge terrible overdraft fees for folks. So that's kind of sad. And even bigger news, which we'll be covering more in July on our July webinar, the FDIC has allowed banks to engage in cryptocurrency and digital assets without any additional approval, which means that more people could be using digital assets and crypto for mortgages, like because now they'll be able to freely move them into savings accounts and source and season them much more easily than they have before in the past. And so you may start to get more questions from people about using crypto in the mortgage process and closing processes. So we're going to be bringing our July webinar will be on crypto and digital assets. So stay tuned for that in July.
I'd like to attend that.
I was going to say, Adam, I might want to talk to you about that separately.
Yeah.
So, and yes, you're welcome to attend any of our, we're going to be doing scams, common real estate scams in June. So you're also welcome to attend any of our seminars, of course.
Great, great. Yeah, the problem with crypto was always getting the statements. Lenders were pretty quick to accept standardized crypto, not the crypto, but liquidating it and then sourcing crypto, I should say.
Yeah.
Maybe these changes are going to be actually using crypto at closing. But the problem was always they always want to see starting and end balances, and something like Coinbase was a nightmare because Coinbase, you could have an account with 500 different cryptocurrencies and it doesn't show a start and ending balance. So you could easily bury money, hide money in there, and underwriters didn't like it. But it's getting better. It's getting better.
Right. So now with this new FDIC ruling, banks who were reluctant to engage in it because just the process, who wants to do the paperwork, get approval, and it's like, I don't want to bother. Now they can just do it. And so a lot of them may be more willing to, and with it becoming more prolific, more people are going to be able to easily just transfer money into their accounts, let it sit for the 60 days and use it. So a lot more easily. So time for us to get a little more up to speed on what it all is, how we utilize it, what are the requirements, what are title companies going to want in terms of, preventing like money laundering, because they have their seasoning requirements as well. And so we're going to cover all of that in July. So
I did have one other scam alert to
Oh, yeah.
that I came across, and it actually was sent to my father, who has owned the house that I grew up in since the 70s. And it's the first time that I've seen this on someone that did not have a mortgage transaction. He got one of those letters in the mail saying you should pay $129 for a copy of your deed. My dad has
Ooh.
had no transaction on the house, no refinancing, owns it outright, and it's from that same company, but it looks a little different, and it looks even more official. It looks even more like it comes from the local government. In fact, so much that my dad actually sent it to me, and my dad's usually really good at like, oh, this is garbage, this is garbage. He was like, have you heard about this? And I looked at it, and it took me a second to realize, oh
Someone
my
had a
God, this is that
closing.
same scam. Yeah, and so beware of that.
Yeah, but did you check to see if anything got recorded on his house? Because maybe someone had a closing and it triggered it.
What do you mean?
Like, did someone take a mortgage out on his house by accident, like fraudulently? Because why
I
would someone
don't,
get that if they hadn't
that's
gone through a process that triggered? Because they search court records.
That's true. It did look, and like I said, it did look completely different than the ones that people
Okay.
that get mortgages. But now that you say that, I should tell my dad to well, I should pull his credit and take a look myself. But
Yeah,
um,
or just go down to the courthouse because there might just be something on the house, not
yeah,
even on his credit.
that's a good point. I'll suggest that he does that.
What county does he live in?
Lebanon County.
Oh, I can pull it for you then.
Oh, sweet. I'll
Just
send you the address.
email me. Yeah.
Awesome.
Just doesn't matter. It doesn't hurt to double check. Doesn't take me but 2 seconds to do it.
Yeah,
Gotta look out for each other. So
love it.
awesome. Well, hopefully y'all learned a little something today and are up to speed on some of the changes happening out there. And hopefully you join us next month for more updates because there's a lot happening out there every day. So got to keep up.
Thanks a lot, everybody.
All right. Thank you, everyone.
Thanks, y'all. See ya.
Okay, see you next time.